or during the class, and if we have time, let's just come back to this. Something relatively new, or rather relatively new as a message, but relatively old as a concept that we've been discussing in the Wyckoff Trading course for quite some time. Behavioral market analysis. What is behavioral market analysis? This is just my humble attempt to talk about the connection between the market participant behaviors and what we see on the chart. It's the connection between how we behave as people and how is that behavior being shown on the chart and how we could understand that behavior. And we are doing this through the prism of the price cycle. And we're doing it as a case study. This is from yesterday's class, so I'm only going to have 2 slides here from yesterday's class. But these are important slides that I wanted to show to you guys, more advanced students, because I didn't have it in the WTC in the previous cycles, even though we've talked about market participants, right? So in price cycle, who are the market participants? I'm looking at this as, 4 major forces that we have to think about. Institutional contrarian investor, those are going to be value investors. These are the investors that are going to go against the most acceptable idea of the bias at this time. In the downtrend, the most acceptable idea on the bias is that it's a downtrend. So their contrarian idea is going to be to go against it. Obviously, they're going to be contrarian at the point of value. And this point of value will be defined by their methodology. This point of value usually will have some kind of climactic characteristics. And therefore, this point will have a lot of liquidity around it. Just think about why liquidity is so important. Well, because the value investor and those contrarian investors have huge size. If they wouldn't have a huge size, they wouldn't act this way. They wouldn't be able even to stop a downtrend from further, falling down on the fears of weak hands. Their time horizon is extremely long. It's from cyclical to secular time horizon. So therefore, they could allow themselves to go into the position early on in our early stages of accumulation in phases A, and they are the ones that are responsible for the stopping of the downtrend and for the initial changes of character. What are they looking for? They're looking for a long-term value. They want to stay in the position for a long-term time and to have a long-term appreciation of the instrument. They want to find short-term liquidity. Those are the spots of where fear is going to be very much present among the weak hands. And when we say weak hands, we don't necessarily mean retail weak hands. We also mean institutional weak hands. And they obviously want to operate and they look for a contrarian sentiment where everything is so bad they come in and they establish their meaningful positions, and that's what changes the behavior of other market participants and the price structure itself. They have some limitations. They are too big of a size, so they can't move really fast. Therefore, they prefer low turnover of their portfolio. They're also very concerned about the tax implications. And those tax implications are such that they don't want to pay extra taxes, and therefore they don't want to have short-term trades. Most likely their main core positions are going to be in cash, leveraged, hedged against by either leveraged participations, by leveraged positions, or maybe just the opposite, kind of like a pair or spread trading. Their edge is in time horizon. Just because their time horizon is so long, that some of the positions that the current CEOs are holding were initiated back then in 2008, 2009 lows, were reaccumulated, re-rotated in 2010, 2011, 2012, throughout the volatility of 2014, 15, and 16, and on the way up through Brexit and the US election in 2016 into the highs of 2017. So you can imagine the flexibility on the time horizon that they have. Their edge is the long-term trend. They can acquire a meaningful position as the value persists at the bottom of the downtrend, and they can hold on to this through the long-term trend and distribute this position on the way up when the weak hands are becoming excited. And from WTC course, we have 2 points of excitement, right? One on the buying climax, one on the upthrust. This is where they love to unload those positions into the excitement of weak hands. They are visible on the charts by the extreme points of volume, by the points of liquidity, by the absolute and relative trends, and by the long-term volume signature. We also, in November, will be studying in the special a long-term momentum signatures. Those are also going to be important for us in identification of the CO buying and then just, smaller interest buying. The examples of such operators are going to be just the definition of the composite operator itself. And I've explained to you guys yesterday that there is a big difference between a composite operator that Wyckoff himself, had as a definition, and I've shown you an article on that, and then other institutions. It was very interesting that Wyckoff, in one of the issues of the Ticker, the magazine, the digest that he was publishing in the early 1900s, he was describing a composite operator as an opposite composite man to J.P. Morgan and Rockefeller and other astute stock operators at the time. He was talking about a heuristic, a composite, and that's why this is a composite operator, a heuristic composite image. I think that the best value investor of our times is Warren Buffett. I think this is just an easier way to imagine who this personality is. Such big funds like PIMCO or BlackRock hedge funds, those are usually all about the size, so you could refer to that. And then the second most interesting group of market participants for us is the institutional trend follower. Those are usually going to be money managers that are going to use growth concept, and they would be looking for the appreciation of prices in order for them to satisfy the limitations that they have. And what limitations do they have? Well, they are money managers, so the performance matrix are extremely important. And their behaviors are going to be driven by the performance matrix as well as assets under management. They're also very much concerned about the low turnover of the portfolio because their clients are very unwilling to be in the portfolio with high turnover. And they're also concerned about tax implications for their clients. They are sizable, they have a big size, and they are cyclical. They're usually going to stay in the position over a year, over 2 years, depending on the stock. And they're looking for the emergence of the trend or a break of the trend. They're looking also for the liquidity and value. Their edge is in their time horizon, cyclical time horizon, long-term trends, whether those are absolute or relative trends, and also in the deep knowledge as well as the deep knowledge that the contrarian investor has. And those are usually going to be your pension funds, insurance companies, investment banks, mutual funds, hedge funds, registered investment advisors. They're going to operate at the specific place in the structure. They are not going to be trying to find the value and catch the bottom. Just because if you're trying to catch the value at the bottom and your methodology is showing that the trend is still not in place, this type of value could fail and we could have a continuation to the downside. Or in the best case scenario, it's just continuation of the trading range. So therefore, just because their behavior is based on the performance matrix, the timing is more important. And that's why all of their models and methodologies are based on the identification of how the trend starts to emerge. And that's when they jump on that trend. In a way, our timing is the same. We want to be efficient with the way how we handle our capital. So therefore, it changes of character on the way out of the trading range, where we could observe phase D with the elements of the sign of strength rally and backing up action are going to be extremely crucial to us. They are going to be high probability points of interest for us, where we would be establishing this position. So in a way, we're acting as institutional trend followers. And we want to stay either in the long-term trend, or we want to dissect this trend into different segments and swing trade those segments. This group also will identify the emergence of the beginning downtrend the same way how they identify the beginning of the uptrend. And they will be on the right side of the trading range when that happens. After the contrarian investors have produced their selling and have sold out their positions, and that in effect have stopped the price from moving further up. And we discuss in details this whole process in the Wyckoff trading course. Where do they sell, why it happens, and what should happen next. So by the time the institutional trend followers start selling either their positions or establishing short positions, the bias has been established. And then we have two other groups. They are smaller groups, professional traders and retail traders. Momentum driven and professional traders are mean reversion driven as well. And I've shown you that mean reversion from the gold trade that I've shown you, right? So long-term campaign and then mean reversion trade in the overbought condition. And that's what professional traders would do. They would trade it like that. And that's why we have so much liquidity at different spots. And that's why here we're going to have an increase of the volume signature in general, an increase of the supply that would lead to some kind of reaction that we're observing right now in gold, in bonds, because they were oversold, and so on and so forth. Their size is small, their time horizon is small, they are looking for the overbought, oversold momentum. For the retail traders, the breakouts, are extremely important, and different points of excitement. There are limitations. Too many trades, high commissions, short-term taxation, lower size, sentiment-driven in the retail case, and lower knowledge and lower skill. These are going to be the definitions for the retail, and then professionals are going to be somewhat better because this is their job, but still are going to have some limitations that are going to go against them if we would compare them to trend followers or contrarian investors. But we do have a lot of quickness. We abide different rules than other investors. We are very much momentum driven. We are not necessarily visible on the chart. Sometimes we do. Sometimes, we'll talk about how weak hands are pushing the rally, and we could see from the weakness that that rally, is retail driven. All right, and I think that's it on this. Let's look at the example really quick. This is Apple daily. Again, behavioral market analysis. What kind of questions are we addressing? Who are these market participants? And how do we identify their presence on the chart and subsequently trade against or in harmony with them? So where are the contrarian investors, value investors? Well, look at the volume signature. Every time we have some kind of spike in the volume signature, when the price goes down, what does it mean? Supply increases, that pushes the price down but yet the price stops from going down, that suggests that there is an opposite force that comes and absorbs that supply. And that's what happens at those points of value that are in green. It's the institutional contrarian investors that are accumulating as the price falls. And it's very logical because they accumulate at the point of value. The point of value is not going to be on the way up for them. The point of value on the way up could be for institutional trend followers. It could be for the momentum traders as they expect the price to go even higher. But for the value investors, the value point is always going to be as the price goes down, and at the point where they see that there is some kind of resistance for the price to go further down, and some other investors are already participating in accumulation. So we could easily see where the value investors come in and establish their positions. All right, well, that's great. They stop the price from moving further down. They support the price. And by the way, think about, this whole uptrend support idea. We started with that conversation. Where is the test in the uptrend environment? These are the tests of the uptrend. This is how the uptrend is being supported by that value investor. And then the next investor, institutional trend follower, is going to push the price off those levels. And it's also going to have an increased volume signature. But the price is going to behave differently with them. The price, just because supply has been absorbed at some point by the value investors, on the additional orders by institutional trend followers is just going to mark up. It's going to go up. And that's what creates the trend. We'll talk about this a lot in the WTC second portion of it. I've developed the trend analysis, classification of the trends, and we'll talk about, this type of scenarios. How do we understand the trend? And then what happens, how does the trend dissolve itself? Well, the same sequence happens again, only in reverse. We start observing the volume signature increases at the points where the price goes up and then just kind of stops. And then we know that this type of volume signature increase usually will suggest the presence of supply. And because the price still goes up, we know that this is a value investor selling on overbought condition. They're seeing the price at this point as overvalued. And they're saying that there is a mean reversion trade built in right here. I could scale out and take some profits, and I hear a lot from institutional guys that I would rather take a profit here. I would rather secure some profitability and then, concern about, maybe getting back into the position again. That's just how they think. We cannot argue with the efficiency of what they do. We can only understand how they think, how they behave, how we could see this on the chart, and what it means for us in terms of the trades that we do. Because like in a lot of cases, and I was thinking a lot about this particular trade here on the change of character, because I'm in 2 trades like that, and I was in Roku trade on the upside, and now it's changing its behavior and it's exhibiting the same characteristics. So I was thinking that one of the best trades is actually on the change of character itself. And obviously I'm trading that, but I want to show it to you guys. All right, so as the value investor sells and then sells again at the higher price, what happens? That finally stops the price from further advances, and then the price deteriorates and breaks the trend. Ooh, when it breaks the trend, the new force comes into the equation. It's those institutional trend followers. No longer they see that the uptrend is being sustained. And therefore they are concerned about their performance. Think about why they are acting the way that they act. They always responsible to their clients. but the performance and the way how they get that performance. So they want to be quick in the changing environment and get out of the position, the one that shows some breaches in the structure or some relative performance. And and here we see that the price quickly goes down, creates a low, slightly low, and that happens on the increased supply signature. So we know that the trend followers are giving up their positions. They're giving up positions later again, and then we have a general capitulation. This sequence of how distribution happens on the way down in the downtrend has been discussed in the best of Wyckoff in my presentation, and I will be discussing this in the Wyckoff trading course. I will introduce those concepts also to you guys, students, in this course as well, because this is something new that I brought in, as a presentation. All right. Where are we? We are 10 to 5, so we have about 40 minutes. Okay, great. We're going to go into the next exercise. And this is where I probably would prefer to have a volunteer if we have one. So just say yes. And this exercise is going to be on the price and volume. This is one of my favorite exercises, just because you have to think a lot about, how you analyze the chart and what what definitions you give to the specific price or volume signature. The task of this exercise is very simple. You are given a price structure of a stock, and you also have given the initial volume signature. Those are your reference points. I'm giving you the time reference as well and the price reference as well, but those are less important. The key here and the task is to construct the volume signature based on the observation of the price action. So we know that as the price moves in a specific way, that's going to be done with the specific increases or decreases or spike increases volume signature. And therefore, we want to figure out, how that volume signature is going to look. Now, it's a very valuable educational tool for this particular class. Why is that? Because it just deepens your knowledge of the relationship between the price and volume. And usually I have such a great feedback from students after this exercise, because they usually say, I've never thought about thinking of volume through the price or thinking about the price through volume. Because in the next class, the next exercise is going to be looking at the volume signature and not having the price signature, and then identifying the price signature or approximating the price signature based on the volume signature. That one is even more challenging than this. So, and we're going to do this next time. So, any volunteers, say yes, and I'll unmute you. And again, guys, don't stress out, too much about, getting into the hot seat. The key here is just to gain as much value as possible from the class by volunteering, by participating, by thinking about these concepts, and so on and so forth. And I don't have a volunteer. Oh my gosh, seriously. We have so many people on the call. Step up, step up. All right, let's go to Eric. Eric. Hey, Eric, how you doing? Eric, are you there? All right, so something with the microphone really quickly. So while Eric is adjusting the mic, all right, so what we're gonna do here is we're gonna start looking at the points of interest to us. How would you analyze this? How would you come up with the solution to this exercise? Obviously, by looking at the price signature, you would notice, some periods of volatility, diminished volatility, and those are going to be identified by the volume signature in a specific way. Eric, are you there? Hello, hello. Are you there, Eric? I heard something on the background, so something worked at some point. Okay, well, let's wait for a little bit more, and I don't know, Eric. If that doesn't work, let's see if maybe someone else would like to step in. If not, then I'm just gonna do it myself. Oh, okay, Eric, yeah, so some problems with the mic. Okay, anyone else? Anyone else? Going once, going twice. All right, so let me just go through this myself, and maybe it will be easier. But I do anticipate, guys, that we're gonna have a much better communication when the actual class is gonna be without any guests or anything like this. So I'll be on you on this. All right. So as I mentioned, we're looking for the pockets of increased volatility, and we're looking for the pockets of decreased volatility. We could find the increased volatility in the way how the price behaves, usually in the increase of the spread. And whenever I say increased volatility, I actually do mean increased volatility on both sides. I do not refer to the increased volatility of, just for the price moving down. But when the price moves up, we also have increased volatility. So where do we see that? On the upside or to the downside? Well, I definitely see that a reaction like this most likely will have some, increased volatility. Next reaction will have, that type of volatility as well. There is a lot of volatility that I would be expecting on the latest two reactions at the right portion of the chart. So these are the areas where most likely we would be expecting that increase of volatility to be present. We also probably would have smaller pockets of volatility where, let's say, the price cuts down some support or overcomes a resistance, and this is where we might have just some increased volatility. So where those points are going to be? So maybe something like this. These are the points that we would have that increased volatility. And I just want to notice those and just identify these points as the points of interest that are going to have some kind of either volume spike or some, consistency in the volume signature. And we want to understand that these are the points where the volume is going to be the highest. All right, next task. What do we look for next? Let's look at the volatility to the upside, right? So where is that? Usually the breakouts are going to have the increase of the volume signature. So for instance, a breakout like this, a breakout like this, and please note that I'm identifying the breakouts that are actually successful breakouts, right? That had some kind of volume signature behind it, and most likely we could say that, well, at least at the minimum, we could probably speculate that there was some increase in the demand signature during this period of time where let's say the breakout has happened, especially in the moments like this where we have like 3 momentum bars and they're breaking out of the meaningful formation. We're definitely going to have the increase in the volume signature, and we're going to have some kind of consistency of that volume signature. Maybe less so with the volume signature on the breakout that breaks out but then retraces back. So still some consistency, but maybe relative to the previous volume signature, we're going to see that the demand is diminishing and the momentum is diminishing as well. we also want to note some kind of local volatility to the upside actions at the end of the move. So for instance, look at this. Look at how this signature concludes. It concludes with the run into the upthrust or climactic action, and we kind of expecting that this type of places are going to have the same type of volume signature where there's some kind of increase. So this one right here as well. And I'm just approximating here. So here, a little bit more there. This is an upthrust as well. So, and we see how the first two, and especially this third one, has a lot of supply. So something like this, supply is present. Okay, what else? Well, we've talked about the momentum. Here's the momentum as well to the upside. So here we're probably going to have a really decent demand signature. It probably will be diminishing because that demand that comes in at this low and on the way up, it's absorbing the supply that is below this low, below $11. So the majority of the volume signature is going to come before and then at the peak, at the bottom, and then the volume signature usually is going to dry up, but it's going to stay relatively high relative to other periods just because there is a lot of buying that is happening out of the oversold area right here. All right, what else are we missing here? Probably everything else is going to be somewhat mediocre. We could definitely go into some definitions, other definitions as to how we would look at this volume signature, in smaller chunks. So for instance, if we would look more into this area, there are a lot of testing that is going on. So for instance, a test like this, we usually would be thinking that there is a diminishing volume characteristic at this particular moment, something like this on the test. We would be thinking that this test right here would also have diminishing volume signature relative to the previous low. A quick reaction to the upside probably will have a demand signature behind it. So together with supply and demand, the volume should have a spike in general, as it had a volume spike right here as well. And then a series of tests. And then those tests, obviously, we're expecting the volume signature to diminish on those tests. Break out in the volatility. Look how this volume signature is going to diminish as well. Slight increase in the supply is going to produce a move to the downside, and then some kind of increase in the volume signature here, just because this is a stopping action. So institutions are coming in, they have short-term value within the context of the trend, and they are stepping in and they are buyers at this point. So that should increase our volume signature here. Breakout, slowing of the momentum, so some diminishing characteristics. All right, what else is interesting here? A lot of volatility right here. So in general, just it's not that the signature here is going to be very extreme or different. There might be some pockets of the increased supply, but in general, it's going to be higher supply with volume signature that's going to be increasing definitely on the first reaction, increasing on the second reaction, staying still high with the demand. All right, so that's kind of like a very quick view. Usually during the class, we would have more time to discuss all of this in more details. Let me grab my tools here and really quickly we'll go through this. and we'll just analyze and post-analyze. And this is some of the important things that you should be doing on your own. But I'm kind of showing you guys here as well in the classroom as to how do we post-analyze, what are the things that we would pay most attention to. Okay, let me do this. Dun, dun, dun. All right, great. That was easy. Okay. Here you go. Here's our solution, and here is the solution to the exercise itself. So the key moments here when you post-analyze an exercise like this is just to basically understand what is the main purpose of this exercise. The main purpose is to understand better the relationship between the price and the volume. We want to understand that the price structure is the reflection of the effort or efforts of multiple market participants, and the price structure is the result of the winning effort. And we definitely could be confused a lot with the volume signature itself, because the volume signature does not necessarily reflect the supply and demand per se. It just reflects the number of shares that have been exchanged during this particular day. It doesn't say anything to us about let's say, supply overwhelming demand. It's only when we look at the price at the price itself, that's when we could make that conclusion. And this is one of the biggest mistakes that beginners traders are making looking at and analyzing the volume signature. They see the volume increase and then right away they're assuming that this is bad. Not necessarily. In a lot of cases, we will see an increase in the volume signature that creates a higher low, that creates the resistance of the price to continue with the short-term idea to the downside. And therefore, we would conclude on the effort and the result part that demand is present, and not only present, it actually absorbs the supply and is able and capable of pushing the price higher. Well, let's go through our exercise and let's see what kind of mistakes we've made. All right, so we said that, pockets like this where we're going to have the undercutting of the support or overcoming of the resistance are usually going to have those pockets of volatility where the volume is going to increase. These are the pockets that are going to be produced by the mean reversion traders. They are seeing some oversold value here, so they're going to push the price, and that's what's going to increase the volume signature. These pockets are also going to be in line with the value investors, and they're seeing some short-term value and some short-term pocket of volatility, so they're going to come in and buy at this point. We're still not seeing the institutional trend followers, and they probably will come later on. This volume signature still has a lot of value investor signature behind it, but also on the ways up, like on this rally right here, or let's say on this rally right here later on, we could see how institutions are buying and they are pushing the price up. So they are not just stopping the price from the reactions, but they are buying as well. So it seems like, our definition here was great. Then we said that on the way up, we have some kind of momentum signature, so some increases. Before on the test, we're going to have a decrease in the volume signature. We've done that, so that's great. Check. Then we said that most likely these 2 points are going to have an increased volume signature. Specifically, and here I would have to think a little bit more as to the more interesting question is why one higher than another. So the only solution to this problem that I see comes from the definition of the higher low. Uh, so with the higher low, imagine that, the same type of selling happens here, and just because it's a higher low, then you need more demand in order for you to stop the price from moving further down now, and therefore you're going to have more demand to do that, and more demand to stop it and to push it up at the higher low. So that could be the only explanation that I might have for you guys. We said that on the way up, just because we're breaking out, we might have some volume signature, some increase. So that was good. The test is going to have decrease in volume signature. That was great. So this area we went through well. So that's great. Then we said a series of tests is definitely going to have a much lower volume signature, dimension signature, and we could go into even more details. I mean, we could really go into bar by bar analysis. I'm not going into such details here just because we don't have a lot of time, but next class we'll definitely do this more. We said that we're going to have an increase of the momentum that's going to be associated with the increase in demand signature. That's great. Then momentum is going to diminish and we're not going to see a lot of the volume signature. So that's great as well. Supply is going to increase specifically on this upthrust bar. And that was actually not that bar. This was, I believe, this bar right here. Relative to what we've seen here, this is still, slightly on the high end, but, this is just one mistake that we have. So that's great to know. Okay, so, and I'm wondering why wouldn't it expand? Looks like it should, right? The price goes up on the intraday and then goes down like this. So some demand behind the move to the upside and then some supply behind that. There was a slight increase, but yeah, definitely this was a gap, so it makes more sense. Plus, it's below the support. Yeah, I think this is a legitimate mistake right here. I should look into this. Okay, so, and this is how I post-analyze, right? So I just go through this scenario again. I want to understand what was the mistake. So I don't think that the mistake was that we could not have that increased supply signature right here. I think that maybe just looking at this formation right here, that would suggest some dullness and inactivity, and therefore as supply comes in, it might increase, but maybe not to the same degree as, let's say, something like this, that we have more active supply that comes. And then definitely a gap in action below the support would produce some kind of increased supply signature there as a stop in action. Actually, that was the demand signature right here, right? We said. Okay, so that was actually fine. All right. Then we said increase in the momentum, increase in the volume signature. The test is going to have the decreased volume signature, so that's great. Then that momentum, we're seeing how the momentum is diminishing, so we would assume that the volume signature is going to go down as well. And we see that. And then into the climactic, intermediate climactic action, we're going to have some kind of surge in the volume. And do we have that? We don't have that much. That was a surge. That's a surge as well, maybe not as pronounced. So I'd say that for me, if I'm teaching myself, that would be a very important point, that the demand signature here is more than the demand signature at the end. And it's slightly diminished, but locally still increases. All right, great. Then we said we're going to have some kind of consistency in the way how the price moves here, and the volume is here. We're going to have the climactic run and surge in the volume signature. That's great. We're going to have an increase in supply, especially on this bar, I said. 1, 2, 3. Yes. Awesome. Awesome. 3 bars, and then here's that surge. So we could see that from the tail, supply tail at the point of the resistance. And then obviously increase in the signature here on the supply side. Then we said relatively high supply, but it's probably, I mean, relative to the previous instances, but it's not going to be increasing or anything. It's just going to be there. And then an increase in supply, obviously, as we go below the point of the support. And we said that the majority of the price movement is going to be somewhere here. And then the signature is going to go down, but it's still going to be relatively high to the demand that we previously have seen. And that's exactly what happens. So I would say that maybe some minor mistakes that we had here. This was one. What was there as well? There was another one. I keep forgetting where it is. All right. But then overall, I would say that maybe like 90% was okay. One might ask, well, and Zoltan is here is saying, okay, unbelievable, great, wow, so cool, man. You know, in my question, in your minds, your question should be, how did you do that? Did you look at the chart before? Well, yeah, of course, I've created the exercise, but you put a chart like this in front of me, and I'm probably gonna do the same way. Maybe I'm not gonna be as good because I've seen this chart and I did not necessarily pay attention to the volume signature that much, but the principles of analyzing and constructing the chart like this is gonna be the same. I look at the historical references first, and I look through the price signature, and I know that the price will behave in a specific way to the efforts that are being exhibited by institutions. As they buy and they sell, the effort increases, the effort decreases, and that produces specific price signature. I want you guys to know how to decipher that relationship. It's extremely important for us Wyckoffans to know this stuff. So we will be practicing. Specifically next class, I'm going to give you a different exercise, as I mentioned. I'm going to give you the exercise where the volume signature is present, but the price is not present. And you will have to construct the price signature. That's going to be a lot of fun as well. And hopefully you guys have enjoyed this exercise. All right, let's see what else we've got. Let's vote a little bit. I could show you some of my recent trades. That's vote number one, and we could come back to some of the questions, guys, that you had. So let me know what you guys would like to do really quick. And then we'll go from there. Trades, okay. Yeah, I kind of suspected that that's what it's going to be. Yeah, recent trades. Okay, great. Okay, so I'm going to show you the setups and then I'm going to show you where we are. This is a little bit outdated as of yesterday. I was showing this at WTC. So as I mentioned, a gold trade that I'm in on both sides. Long-term campaign has been established in April, May. I was not hiding this. I was talking about this in WMD and all of the classes. I even gave a presentation on stockcharts.com. You could find the timestamp. That presentation was on April 4th. One of the things, and I'll discuss this with you guys, we all have tendencies as traders, investors, of doing things in a specific way. I have those tendencies as well. One of my tendencies is that I observe the change of behavior earlier in phases in late phase B and act on that. So I'm actively working in my analysis and execution on correcting this mistake, right? So my first position was here and I had to wait for a whole month, and even though this is a long-term campaign, totally acceptable to come into that like that because you're probing, and then scaling in, creating an meaningful position. And Eric is asking, right too early? A little bit too early, and I'm describing my tendency here, Eric. So yes, a little bit too early, but at the same time, I'm stating that for the long-term campaign, when you put on the first probe, you should be okay. Your risk should not concern you that much if the price slightly goes below into a sprint situation below the area of the support. You should account for that. So therefore, when out of this sprint you have other situations and other reversals, then you can add to the position, and that's how you start creating your size. So you could go, let's say 25 basis points, 25, 25, 25, you're already in the position, and then you could add on the way up. Here at the area of the overbought condition, and by the way, this was also a really good intermediate call. A lot of people were thinking that this was already a distribution and we're going to have a more of the trading range. There is a lot of absorption here, the way how all of those probes of supply probes are working. We'll talk about this as well. Out of the overbought condition, point of entry right here on the intraday, I'm opening the position after the upthrust and after the test of the upthrust. And I'm thinking that this is our phase C. I'm adding to the position right here, and then some bad news come on the trade that pushes the price up. But look how it's being pushed. The demand that pushes it is lower than on the previous rally. That's number one. The result is less as well. That's number two. And then the test of that attempt to go up. And then again, guys, because you are more advanced here, I'm going to show you a different test, right? So if this was the attempt to go up, this could be considered a test that happens as a higher high, but on the lower demand signature. So we're seeing how demand has diminished. And then we have a more regular test that is a lower high test. And here we see, this is just a different session, so you can't really compare it in the correct way, but still, this would be our more legitimate confirmation of that action. So currently, let me just quickly see where the futures are. So we are at 1496. So we are somewhere here. Today was a good day, but we had some kind of laborious movement to the downside. My objective is somewhere here, 1480. So as we were moving laboriously, I started thinking that we might actually have a rally here into the area of the resistance. So I started to scale out. I still have a position in gold, a hedge position in gold, and I still have my long-term buy in gold. So my goal here is just to get my hedge out, and hedge worked nicely because my equity did not go down drastically on this move to the downside, and then just to recover from here and even maybe consider adding on to the position on a more meaningful reaction. So this is where we are with that. And look at some of the PNFs here. So there are quite a few objectives here that you could find that are much lower than what I'm looking for. I'm looking for the first objective, like 138.88 on the GLD. This is not the futures. So we'll see how that's going to go. All right, next one, TLT, same concept. I mean, reversion trade, every time we have this type of momentum run in TLT, how does it end up? It ends up as a pronounced low in the markets and then a subsequent move up. And that's why I'm bullish on the market just based on this chart alone. We just had a speculative run in TLT where the bonds are more attractive to conservative investor from the point of view of the appreciation rather than the the interest that is being collected on it. So therefore, these times in the markets are usually going to bring us to a significant oversold condition in the markets, which we just recently had. It was not as significant as, let's say, a shakeout, but still it had a lot of volatility. It was quite difficult to trade that volatility. I was trading volatility itself. I would say that I was slightly profitable rather than really profitable. This gold trade and TLT trade actually, are quite profitable at this point of time. Okay, and let's see at this. Okay, so TLT right now at 141. So we hit our first objective, and today I scaled out some of the position, and I'm just keeping some to see if there's going to be some kind of continuation of this move. The last move to the upside was pure speculation. We could even see this from the volume signature. There is none of this before that is happening. And look at how the price behaves, overthrows into the overbought condition. And my point of entry was right here on this bar. Look at what happens next, kind of like the same as with the gold. There is a lot of effort after demand has decreased and supply has increased to push the price up. And yet, what do? We can't even touch the buying climax high, and we can't overcome the upthrust, right? That comes before. So it starts acting as a test, and then the next test is even better because it's on diminishing volume signature. I had to wait here a little bit, and then everything was fine. So we are at 141 today here. So this is actually, both of these trades are good. I don't have a TLT as a long-term campaign. I didn't have that. Gold I do. So TLT is a pure directional trade, but I'm trading it as a mean reversion trade. And the only way of how this trade was created is from the understanding of the overbought condition, understanding how the institutions are behaving, understanding how the other market participants are going to behave in a speculative way, how that is going to be shown on the chart in different ways, whether climactic way, overbought way, test and action way, increase of the supply, diminishing demand way. There are so many ways of how we could do this. But the understanding of that and the practice that has been done before leads to trades like this. And those are really profitable trades. Both the TLT trade and the gold trade, have been really profitable, actually on both sides, on the upside and now on the downside. All right, 526. I think that we're gonna stop here. Lots of material that we've covered today, guys. Let me see if you have any questions at this point. So write those down in the question box. Zoltan is saying, I have learned so much. Well, great. Obviously, that's what we want. So the key right now is to continue this education, Zoltan, right? So this is just one class, and obviously, the examples that I've shown are just examples of the work that we do here in this class. So I would definitely recommend this, for those of you who want to have a very, in-depth knowledge and in-depth skill. As you could see, both the knowledge is going to be there in this class and the skill building, as we're going to do this through the exercises. And for those of you who would like to take this class, but you have not taken the Wyckoff trading course, which is the prerequisite, please do so. And we just started. We just had one session yesterday. So you still are welcome to sign for the WTC course. So I would advise you guys to do that. And with that, thank you guys so much. I don't see any more questions. I see only comments of thanks. And I thank you guys for being here. and for going through this class with me. And hope to see you either in this class or in the WTC. Thank you so much, and bye-bye.